Good evening, everyone.
Good evening, sir.
How many have joined? Okay, I think we can start. Right, so let me give you an introduction to what we are going to do today. As you know, we have already done the statement of comprehensive income, statement of financial position, statement of changes in equity. Those are the ones we have done. Right, so statement of comprehensive income, where it captures the income and expenses of the business, right? So that we have already learned. Then statement of financial position, as you know, takes care of assets and your liabilities together with equity, right? Then we also have statement of changes in equity. This is basically your equity components, right? So when you look at it as a whole, the three financial statements talks about the important elements in accounting. The important elements in accounting. So what we are going to look at today is the statement of cash flows. Statement of cash flows. So what does that talk about is basically the cash flows of the business. The cash flows of the business. So for any user of financial information, this is what they expect. This is what they expect. So what is the income of the company? What is the expenses of the company? So ultimately they know what is their profit or loss. Then what is the asset base of the company? How much of liabilities are there? How they are financed or how they get the capital. Then statement of changes in equity. What has happened to the company with regards to its capital and reserves during the year. During the year. We are talking about a financial year. But ultimately, the user will be very much interested to know what is the company's cash flows. Cash flows. Right? So that is what we are trying to learn today. Go through today the cash flows of the company. Cash flows of the company. Right. So what do you mean by cash flows? So cash flows basically takes two forms. One we call it as inflow, the other one being outflow. Right? So you get cash inflows and cash outflows. Now what do you mean by cash inflows? Cash inflows means the money or the cash that is coming into the business, right? That is coming into the business. So that is like an inflow. inflow. Right? Then, what do you mean by outflow is money or cash that is going out, goes out. So if you are the business, this is how it happens. Money that is coming in or the cash that is coming in is a cash inflow. The money that is going out of the business or the cash that is going out of the business is a cash outflow. Right? Just take down this. So when you really look at how money or cash can come into the business, can somebody tell me how money or cash can come into the business? Any idea? What do you think? How does money can come into the business? Yes? Anyone? You all can hear me, right? Am I audible?
Yes, sir.
Right.
Yes,
Money can be visible.
But I'm not getting any response. Pardon?
Profits.
Yes. So how money can come in is any business activity that you do which brings in revenue. We call it as revenue or income. That is what is going to bring in cash to the business. Right? On the other hand, what is going to make cash to go out is where you incur expenditure or purchases. So either you can incur an expense or you can do a purchase. Right? So what is revenue or income? What do you mean by revenue or income? When I do a sale, I sell goods to people. So we have already learned, people might give you cash, or what is the other mechanism? Yes? What is the other mechanism that you can sell goods? You can sell goods for cash, or what is the other? You can sell goods for credit. You can sell goods for cash or you can sell goods for credit. Isn't it? Are you all feeling sleepy? Because I am just coming here and shouting at 4 o'clock on a Sunday evening. But but I am not hearing anything. What is happening? So when you do a sale, you can do two types of sales. You can do a cash sale or a credit sale, right? So when it comes to the cash flows, what matters is this. This is not relevant because here you have not collected cash. You have not collected cash. So we are not worried. The moment I do a cash sale only, I get money coming in. Money coming in. Similarly, when I do, this is a sale, right? Now let's look at a purchase. You can do a cash purchase. You can do a credit purchase. Right? I am not teaching something which is new to you. This has been already covered. You can do a credit purchase or cash purchase. Now what matters for the statement of cash flow is again is a cash purchase. Why? Where you need to immediately pay cash. Whatever that you do in the form of a credit purchase is not important because the cash will come later. Right? Cash will come later. Then there could be various other activities that a company can enter into where cash might come, cash might go. Now I just saw reply from you all for this first question that I asked. Somebody said investments. Good. But when you make an investment, what happens? Cash goes out because you need to give money and purchase. Because what do you mean by investment? You go and invest in shares. So you need to give money. Then only they will give you shares. Right? If you are going to put a fixed deposit, you need to go and give money to the bank. Then they will say, look, we have put a fixed deposit in your name. This is the certificate and this is the rate. After a period of 12 months or 3 months or whatever, you will get this amount, capital plus interest. Right? So basically, we are looking at how the money could come into the business and in what ways the money could go out. Okay, so I hope you would have taken down this. If you want, just quickly take down. You all can see the board, right? Is it visible to you all?
Yes, sir.
Right. You must speak, otherwise I don't know whether I am talking to you all or you are not. I'm not heard by you all. Right. So let's get into the presentation where this handout was given long time ago. So we are going to look at statement of cash flows, which is basically an accounting standard. Statement of cash flows is an accounting standard, basically. Right? So what is the accounting standard? The standard goes as LKS 7. LKS 7, that is Sri Lanka Accounting Standard. The number is LKS 7 and the name should be statement of cash flows. In examination, they have asked what is the relevant standard which is applicable for cash flow statements. So your reply should be Sri Lanka Accounting Standard LKS 7. Then you have to say statement of cash flows. Right? Okay. So cash flows. Statements of cash flow are a useful addition to the financial statements of companies because it is recognized that accounting profit is not the only indicator of a company's performance. So I already explained. Now, when you look at a statement of comprehensive income, you get the profit or loss. Then the statement of financial position, you get the assets and liabilities. But what is more important for a person who is interested in the company is to know how this company is managing its cash position. Because the moment a company is not having adequate cash, that's the end of the company. That is what we call as bankrupt. In banking terminology, when you say bankrupt means you don't have cash. You are almost dead. You are almost dead. So there are situations where companies have gone bankrupt. People have gone bankrupt. Oh, what do you mean by that? That is, you are not in a position to meet any of your liabilities. Any of your liabilities. So that is a crisis situation. So every company should be very careful with regard to their cash flows. That is why it says it is not merely the accounting profit that somebody would be worried. There is something else which is the cash position. Which is the cash position. So it is very important. So it is very important that you meet the cash requirements of a company. Statements of cash flow concentrate on the sources and users of cash and are a useful indicator of a company's liquidity and solvency. So when you look at a company, you need to know how this company is getting money or cash. That is called the sources. The sources from which the company is getting cash or financing. Users means how this company is making its expenses, on what it is making, whether they are investing, whether they are purchasing fixed assets, or whether they are making expenditure. So all those information will be very much useful for a company's liquidity. We call it as liquidity. As long as you have cash, that is your liquidity position. Solvency means you are dead and gone. You are dead and gone. So the survival of a company depends on its ability to generate cash. Okay, so how we say that the company can survive or it can last for long depends on what is the capability of this company to generate cash. Now just imagine, now we are under a pandemic situation, and you might have already heard there are so many companies who are already struggling. Why? Because they have lost revenue. There is no business for them, no sales. So when you don't have sales, how will you generate cash? Now say for example, a company which is closed for business, but can the company survive without paying salaries to the staff? No, they can't. Now even under the lockdown situation, all the banks have paid salaries to their staff members. even though there was a lockdown. The banks are not functioning, but still the staff has to be paid. Now that is why a lot of companies today have retrenched staff. They have sent home. And for most of the staff, they have paid only 50%, 30% salary. What is the reason? There is no revenue coming in or income generated, but you need to make the expenditure. Now look at this situation. You are incurring expenses, but no revenue. Ultimately, what will happen? You are at a loss situation. So this is the reason why most of the businesses today are struggling and about to be closed. So what we are learning today is a very important topic as far as any business is concerned, because this can lead to a critical issue for a company. As long as you don't monitor and follow up on your cash flows, it will be a disaster for the company. Therefore, cash flow becomes more comprehensive than the profit that we are talking about of a company, right? Because right now we know the profit or the accounting profit. Now say when you prepare a statement of comprehensive income, you get a profit. You say profit after tax. Now that is just a number, because there are a lot of assumptions and conventions and concepts are applied. Because for example, you are making depreciation. Now the depreciation doesn't have any cash impact, but it's an expense. That you are incurring. So basically your profit means actually it's nothing. What is more important is the cash flow that you are generating. So let us look at some definitions. What do you mean by cash? Cash means it is the cash on hand and the demand deposits. We call it as cash on hand and demand deposits. Cash equivalent. Cash equivalent are short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Right? Right. So, let us look at the definitions. So we call it as cash. The definition says cash. Cash means what? The cash on hand, and it also says demand deposits. Right? Now let us look at this first. Here is a business. Now businesses, what do? They can freely operate using cash. This is the notes and coins. Physical cash, cash notes and cash coins. That is one option. Or they can have a bank account. You can have a current account, you can have a savings account. So for the purpose of statement of cash flows, we call both these as cash. Both these as cash. So what do you mean by demand deposits here is the bank accounts. The bank accounts. We don't take the fixed deposits here. It is the current accounts or maybe the savings accounts. Be the current accounts or it could be the savings accounts. Okay. Now the next one we say cash equivalent. Cash equivalent. So if you want, you can take down. Okay. So the next one is cash equivalent. So the business might have certain assets which are known as liquid assets. What do you mean by liquid assets? Assets that could be converted to cash. Converted to cash quickly without any loss in capital or interest. This is the simplest definition. What do you mean by liquid asset is any asset that you can convert it or convert to cash quickly without any loss in capital. So if I invest 100,000 today, I should be able to get back that 100,000. If the bank says no, I can give only 90,000, then there's a problem. And when I invested, I also wanted some interest. If the bank says no, I can't pay you interest, then again there is a problem. So what you can call as a liquid asset is where you can quickly convert it into cash without any loss in capital or interest. So what are the things that you can consider under this scenario? It could be any short-term investments. We call it as short-term investments. Generally, this short-term means 3 months. We call it as 3 months. Short term is your 3 months. So any investment, any deposit you can have for a period of 3 months can be called a short term investment. Short term investment. So the next definition was cash flows, which I have already explained to you. It is the cash inflow and the cash outflow. So if you want, you can take down this. Right? Now the next thing that we are going to do is, now you already know cash and cash equivalent, and now we have looked at cash flows also. Now for the purpose of statement of cash flows, we can divide the business activities of a company into 3 categories. Into three categories. We call them as operating, investing, and financing. Operating activities, investing activities, financing activities. So these are the three broad classifications where you can either receive cash or you might have to pay cash. Okay. So there could be an operating activity where you might receive cash or you might have to pay cash. There could be an investing activity where you might receive cash or pay cash. Financing activity means there is an activity which can be due to financing. You can receive cash or you might pay cash. Now, what do you mean by these three activities? Operating activities is generally known as your principal business activity. So if I am buying and selling products, that is my principal activity. Selling products is my principal activity. So I get money by selling goods. Now, what is the principal activity of a bank? What is the principal activity of a bank?
Taking deposit and lending.
Yes, that is providing financial services. So that will be my principal business activity. Now what will happen? I will accept deposits. So what will happen? Cash will come into my bank. I will give loans. What will happen? Money will go out because people will come and borrow me from me, means I have to give out money. So that is called the operating activities from the principal business activity. Right? Then the second activity, in order to carry out my operating activities, I might do certain other activities. What are those? Where I might go and acquire non-current assets or make investments. Now you know, how does the banks run their business? They purchase computers, they purchase furniture and tables and chairs. Then they also go and purchase buildings or rent out buildings. So there are a lot of investing activities that you do. How? You go and acquire non-current assets. So which means property, plant and equipment, like those stuff. And some instances, what happened? Due to your operating activities, you might have excess money. Where you can't do anything. So what you can do? You can go and make investments. Say for example, if you are a bank, what happens? You accept deposits. So money comes in. But you are not in a position to give loans to everybody, especially under this condition, where under the pandemic situation, you can't give loans because every business is crashing. So what you can do? You can go and make investments with the excess money that you have. So those type of activities which results in cash inflow or cash outflow, there could be both. Those are known as investing activities. And the last type of activity is called as the financing activities. Now, financing activities happen when you are struggling to find cash, or you are finding it difficult to finance your business. So where does this happens? Any changes to equity position or borrowings. So in other words, the ways and means that you try out to finance your business is known as financing activities. How does this happen? Let's say you don't have adequate capital. You don't have adequate capital. So what do? You go to your shareholders and tell them that I need money. So what do? They will give you money and you will issue them shares. You will issue them shares. I have already spoken about these in the class. So when you are short of money or short of capital, you can always go to the shareholders. Look, my business, I am struggling to improve it, or maybe say I am looking at some expansion. Can you give me some capital? Yes, we can give you US shares. But issuing shares is a very costly exercise. Issuing shares is a very costly exercise. Issuing shares is a very costly exercise. But the alternative is where you can easily go and borrow. That is less costly. This is less costly. So you go and beg from people. I'm just kidding. You go and ask for money from several people, not from your shareholders, but from others. So there are lenders. There are lenders who will give you money. So what happens? There will be money coming in to your business. You will go and borrow. Now these borrowings are not free. These borrowings are not free. So when you borrow, money will come in. But at the later stage, you need to pay them back. What will happen? Money will go out. Money will go out. So every activity that is described here has its own cash inflows and cash outflows. Cash inflows and cash outflows. Can you take down this? So let's go back to the presentation now. Right, so the three definitions are given. What is operating activities? Operating activities are the principal revenue producing activities of the entity and other activities that are not investing or financing. So all activities that you consider under operating activities will not be considered under investing or financing. Similarly, investing means the acquisition and disposal of non-current assets and other investments not included in the cash equivalent. Then you have financing activities are the activities that result in changes in the size and composition of the equity capital and borrowings of the company. Right? So I'm not going into details of these because those are like just basic information. We need to see how we apply these. How we apply these. As I mentioned to you, when you say cash and cash equivalent, generally the maturity date of the investment should be normally 3 months from the date of investment, right? From the date of investment. So we also looked at, when you say cash and cash equivalent, I said, when you say cash, it is the physical cash and the demand deposits. Now, when you say demand deposits, what does it mean? There could be a savings account. There could be a savings account. There could be current accounts as well. There could be current accounts as well. Right. Now, suppose if there is a current account. Suppose there is a current account. And if that current account right. So you need to be very careful about understanding this. This is very important. You have the business here. This is the bank. Right? Business and the bank. So the business is going to go and have a current account open. The current account is open with the bank, right? And you go and deposit, let's say 10,000 rupees. 10,000 rupees, right? Now you tell me, when I have 10,000 rupees in my current account with the bank, is it an asset or a liability for the business? Asset or liability?
Asset.
It's an asset. So the bank or the current account balance, when it is, we call it normally as credit balance, huh? Right. So it's a asset for me. What is it for the bank? For the bank?
Liability.
It's a liability. For the bank, it is a liability. Right. Now it is clearly understood. Now this is a cash for the business because this is like the demand deposit. So you have cash. Now this customer or the business, what do? They have purchased some goods. They have purchased some goods. So they issue a check. They issue a check for rupees 25,000. 25,000. Can you issue a check for 25,000? Can you issue a check for 25,000?
Can so if they have OD facility?
Right. So there you are. So if the business has an arrangement with the bank, I might have only 10,000 rupees, but I can do transactions for more than that. So the company issues a check for 25,000 and that check comes into the bank account. And that check comes into the bank account. Now what will happen? What will happen to the bank account balance?
Excess balance will be.
So you had already 10,000 rupees credit. Now there is a debit of 25,000. Now what will happen? You will turn into a 15,000 debit. Do you understand that? 15,000 debit. So initially you had a 10,000 rupee credit balance. So you called it as an asset. Now what is it? Now what is it? Now it becomes a liability. Now it becomes a liability because you will have to pay another 15,000 rupees to the bank to make it zero, right? Because you only had 10,000. Now you have like borrowed 25,000 from the bank by issuing the check. So you became 15,000 debit. This situation is known as overdrawn. That is what one person said. You become overdrawn. But in order for you to become overdrawn, you need to have a prior arrangement. You need to have a prior arrangement. You have to have an arrangement with the bank. Look, I will overdraw this account up to this much. That is what banks do. They issue overdrafts. They issue overdrafts. So when you are doing questions or considering cash position of a company or a business, it could be a debit balance, it could be a credit balance or a debit balance. Or in other words, it could be a favorable balance or it could be an unfavorable balance. But you need to consider both. You need to consider both. Okay? Please take down. Okay? So that is what it says. In some countries, however, bank overdrafts are repayable on demand and are treated as part of entity's total cash management system. In these circumstances, an overdrawn balance will be included in cash and cash equivalent. Such banking arrangements are characterized by a balance which fluctuates between overdrawn and credit. Okay, so this is all what I explained on board is given in text form. Right. So as I told you, the statement of cash flows have to be presented in a format where you capture the three types of activities. Three types of activities. What are the three types of activities? Operating activities,
Operating, investing, financing.
Investing and financing activity. Okay. And then you get some examples of what could be included under each activity, right? So I'm not going to go in detail, just read through this. What are the things that you can consider under operating activities, right? And you have to be mindful when you say operating activities, the items that could be included under operating activities will have a result of either receiving cash or paying cash. You have to always keep that in mind. Now, every example that is given here, you may see that the result of that transaction will be either to receive cash or to pay cash. One of the two things have to happen. Then only you will go and include it in the operating cash flows or operating activities. So look at the items. Cash receipts from sale of goods. So that is very obvious. When you do a sale, you will receive cash, right? But we are not considering here about the credit sale. As I told you, credit sale is not valid because credit sale, the money will come later. So when the money comes only, that will be considered as part of cash. Cash receipts from royalties, fee, commission, and other revenue. Okay. Then cash payments to suppliers for goods and services. So when you purchase something for cash, you have to make cash payments. Then cash payments to and on behalf of employees. So when you make salaries to your staff members, you pay salaries. Can you say you can pay salaries on credit? No. Employees will want to have the salary in cash, or they want you to credit it to their account. You can't tell them that, okay, look, I will give you on credit. No, that is not possible. Then what can be included under investing activity? Cash payments to acquire property, plant and equipment. So if you are going to buy a computer today, that is acquiring a non-current asset. Now, when you go to acquire an asset, what will happen? You have to pay cash. You have to pay cash to the shop and then only you can purchase it. So, investing activity includes all such activities which can be to acquire new assets. Then you can have cash receipts from sale of property, plant and equipment. It is not only to purchase or acquire assets. Sometimes you might think, okay, I have an old house or a building which is of no use to me now, I can sell it. So when you sell, what will happen? You will get money. You will get cash. So that is called disposal. When you dispose an asset, you get money. If you can recall what we learned on LKS 16. On LKS 16, we learned disposal of assets. What do you do? When you dispose an asset, sometimes what happens, you get sales proceeds. Sometimes you get sales proceeds. So this is what that we are referring here. The sale proceeds that you get from a disposal is coming under investing activity. Then also you can say cash payments to acquire shares or debentures of other entities. That is also possible. You can go and invest in companies where they have shares or debentures. Okay. So likewise, there are so many examples under investing activities. Then we have financing activities. What did I tell you? That is something related to your equity capital or borrowings. So you can receive cash from issuing shares. You can make cash payments to owners. What is that? Sometimes you can buy back shares. So this is a share buyback. Now there is another element that you make a payment to your shareholders. What is that called?
Dividend payment.
Dividends. When you make dividends, what will happen? You have to pay cash. You have to pay cash. So when you pay cash, there is a cash outflow. So that will come under financing activity. But you have to remember now under the current scenario, there are a lot of companies which are practicing, especially the banks are practicing. They don't pay cash dividends. They don't pay cash dividends. They pay, what did I call that? You pay dividends in the form of shares. In the form of shares. So instead of giving cash to the shareholders, you give shares to them. Right? That is known as what? What is called?
Profit after retaining earnings.
No. What I mean is any payment of dividend to shareholders in the form of shares is known as a scrip issue. I don't know whether you can recall. We learned about it. Scrip issue. SCRIP. Scrip issue. So if you hear the term scrip issue means what? Company paying dividend in the form of shares instead of giving cash. Instead of giving cash. Right. So when you are preparing a cash flow statement, there are certain steps to be followed. And there are methodologies also. So according to the accounting standard, that is LKS 7, it gives you two options. It gives you two options. One is known as a direct method. One is known as a direct method. The second one is an indirect method. An indirect method. So these two are very important. These two are very important. What is a direct method and what is a indirect method? Indirect method. Right. So if you are a small business concern, what you have to do is you have to record all your transactions. Record transactions. Right? You are a very small business. So what you do, we will mark all cash inflow. You will mark all cash outflow. Right? From what and what you got income or inflow, for what and what you have to pay. Right? Then when you bring it to the statement of cash flows, that is known as the direct method. That is known as the direct method. This is something very difficult to do in a business context. That is identifying each and every transaction which has resulted in cash. Which has resulted in cash. Similarly, you have to find out each and every transaction which has impacted as a cash outflow in terms of cash. Now, this is very difficult in a business concern. Say, for example, let's take a bank. In a bank, do you know how many transactions taking place in the form of cash? You can't imagine. For a day, there could be about even more than 100,000 transactions. So out of the 100,000 odd transactions, you have to find out what are the cash transactions. Either receipt or payment. All these are called receipts. And these are payments. Right? So if you can monitor and identify each and every cash receipt and each and every cash payment, then when you take it to the statement of cash flows, that is known as direct. Right? This is very difficult, but an easy way of doing the cash flow. An easy way of doing the cash flow. But generally what we do is, we can't do this. This is not practical. Maybe you can get an exam question to do it like this, but in practically, when you look at the businesses, due to the business volumes or transaction volumes, this is not practical. So what most companies do is, they offer the indirect method. Indirect method. Indirect method means we don't consider the actual receipts of cash and payments. We don't consider the actual receipts and payments. Instead, we start with the profit or loss of the company. Right? We start the cash flow using the profit or loss of the company because we don't consider anything else. There could be many cash receipts, many cash payments, everything is given there. What I take is, straight away I will take the profit or loss and start doing the cash flow under the indirect method. So the direct method and indirect method difference you need to understand. Direct method means where you have to extract the actual cash receipts and the actual cash payments. Then you do a cash flow based on that. But under the indirect method, you don't have to worry about all these. You straight away take the profit or loss from the statement of comprehensive income and start doing the cash flow. Start doing the cash flow. Right? So I can break this into two. How? Statement of cash flow this is the direct method, this is the indirect method. Right? Under the direct method, what you need to do? Capture all cash receipts, capture all cash payments. So the net will give you the net cash flow. But in the case of an indirect method, you have to start with profit or loss and then adjust all non-cash elements, all non-cash elements of cash flow. Now this is where the indirect method becomes little tricky. Indirect method comes little tricky. How do I know what are the non-cash elements or non-cash transactions. So that is a bit of a tricky point when it comes to the indirect method. When it comes to the indirect method. So basically what they have been doing is like you start with the profit or loss and you adjust all the known non-cash elements that are included in the statement of cash flows. By doing that, what will happen? It will come back to this. So you need to understand the difference. Why you say direct and indirect means here you have to identify each and every cash receipt and payment. Now, if you are unable to do it, what is the alternative? You can go for the indirect method. What do I do there? I take the starting with the profit or loss. I need to eliminate all the non-cash elements of the business. All cash flows that are having non-cash elements that I have to eliminate. So when I eliminate those, automatically I am coming to this. Right? I am coming to this. So the methodology that you adopt is slightly different between the two. Okay? So please take down this. Okay, right. So let's go back to the presentation. So that is about direct method and indirect method. Right. So when you use the direct method, as I told you, you need to consider all the gross cash receipts and payments. Okay. So you need to go through your ledger, extract that information from your accounting records and prepare the cash flow. What happens is that is not easy. Going through all your records, accounting records is very difficult. So that is why people, what they do is they opt for the indirect method. Because indirect method will be easier because you have to just start with the profit or loss and adjust for the non-cash activities. Right? Now, identifying the non-cash activities will be the biggest challenge. Let's look at what. This method is undoubtedly easier from the point of view of the prepare of the cash flow statement. So very simple, you have to take the net profit or loss for the period and you adjust for the following, right? Now you have to be very careful. You have to understand this part very clearly. What are they saying? Changes during the period in inventories, operating receivables and payables. Right? Now you know what is receivables, what is payables and what is inventory. Inventory is your stock. Right? So what are they saying? All your changes that have happened during the period in stocks, in your debtors or receivables, in your creditors or payables, that you need to adjust. That is one. So all these elements that I told you now are known as your working capital items, working capital. Then you have to adjust for the non-cash items. Non-cash items. What are the non-cash items? Obviously, you know the depreciation. So when you do a depreciation, what happens? It is just a book entry. There is no cash involvement. When you do provisioning, there is no cash involvement. When you realize profit or loss from the sale of assets, because what you have received is the sale proceeds, not the profit or loss. And thirdly, all other items, the cash flows from which should be classified under investing or financing activity. Okay. So let us try to understand what these three elements that we spoke about just now. Right? So you need to understand this very carefully, right? Now what you do under the indirect method, you take the profit or loss and you have to do the adjustments, right? Now the first adjustment, they say depreciation. Depreciation, you know that it is a non-cash item. Non-cash item. Why? Why do I say it is a non-cash item? Why do I say that it is a non-cash item?
It's also a disposal
Pardon?
because of the disposal.
No, 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 no. I'm asking depreciation, why it is a non-cash item? Because when you make depreciation, what is the double entry that you will post? Debit, depreciation charge, and credit, accumulated depreciation. Am I correct? So, what is the involvement of cash here? Do we get cash? No. There is no involvement of cash when you book your depreciation. Right? This is your P&L. This is your balance sheet. Or this is your statement of comprehensive income. This is your statement of financial position. So, when you book depreciation for your assets, fixed assets, there is no involvement of cash in this. Right? No involvement of cash. So, this becomes a non-cash item. Non-cash item. This is the very well known non-cash item in businesses where making depreciation. Right? So now look at what do we do with the depreciation. Now when you take the profit or loss of the company, let's say I am taking a number 15 million rupees million. The profit of the company is 15,750,000. Just an example, right? And I say that you have provided depreciation of 250,000. 250,000. 250,000. 250,000. Now, because of this depreciation, what has happened to this profit? Can somebody tell me? Because of this depreciation, what has happened to this profit? Yes. Tell me. Now this is after the final. This is the final number. Profit or loss is your final number. What you are going to publish to the stakeholders. So now, because of this depreciation, what has happened to this profit?
It has reduced.
Yes, it has been reduced by 250,000. If not for this number, what should be the profit? What should be the profit? If this depreciation was not there, what would be the profit?
$16 million.
How much?
16? 16?
16. Yes, very good. So, if I don't consider this depreciation, what would I do? I would have added this depreciation. Then it would have been 16 million. So, when you are preparing cash flow under the indirect method, this is one of the first adjustment that you do. Depreciation, you have to add. You have to add. Do you understand the logic or rationale behind adding depreciation? Let me explain it again. When you provide depreciation in your profit or loss, you debit the P&L account depreciation charge and credit accumulated depreciation in the balance sheet. Let's say you have provided a depreciation of 250,000. Suppose if your profit or loss is 15 million and 750,000, what is the impact of depreciation in that is your profit has come down by this amount. So if this depreciation was not there, my profit would have been 16 million. So what I am trying to understand here is, I know depreciation is a non-cash item. So under the indirect method, if I am starting with the profit or loss, I need to eliminate this non-cash item. So what do? I will add back the depreciation. Add back the depreciation. Right? This is the first item. Second item, any provisions. Any provisions. What do you mean by any provisions? Let us say you have forgot to pay your water bill by the end of the financial year. Because if you had paid it, you would have paid it by cash. But unfortunately, you have forgot to pay your water bill. So now the auditors are coming and telling, look, you have not paid your water bill, so please make a provision. We make provisions under which concept? What is the concept? Provisions are made under which concept?
Error.
No.
Prudence concept.
No. What is the concept?
Prudence.
No.
Non-account.
No.
Accrual concept.
Accrual concept. Accrual concept. Still not revised. Okay. So under the accrual concept, what is the double entry that you will pass? I will debit the account water bills or water bill charge. Right? And credit accrued expenses. Or you can call it as payables, whatever. Accrued expenses. Now this is my P&L. This is my balance sheet. Right? Look. Now what is happening here? Is there an involvement of cash? Is there an involvement of cash? I am debiting a P&L account known as water bills, crediting an accrued expense account in the balance sheet. Ideally, if I had paid the water bill, I would have still debited this. But what would be my credit? What would be my credit?
Cash account.
Cash account.
Cash.
Yeah. So if I had paid out of cash, then there is no issue. Now the problem here is I have not paid out of cash. So the provision that I have made does not involve cash. Does not involve cash. Here comes the second non-cash item. Non-cash item. So now tell me, because let's take an amount also. Let's say 100,000, just for argument, right? The provision that you have made is 100,000. Now tell me, because of this 100,000, what is the impact in the profit? What is the impact in the profit? Because of this provision, what is the impact in this profit?
Reduced.
Reduced, yes. Because of this provision of 100,000, my profit is actually less by 100,000. So what should I do? I need to adjust it into my cash flow statement. So water bill provision. What do I do? I will add this. Okay. Is that clear? Right? So this is an expense provision. Any provisions in the sense, this is a expense provision. If it was an income provision, what will you do? You will deduct it. You will deduct it. Okay? So likewise, there are a lot of items which can be considered as non-cash items. So when you find such items in the cash flow, you need to adjust them if you are using the indirect method. This is the indirect method. Please note. Indirect method. Okay. Please take down. Right. So let's go back to the presentation. Right. So this is the template when you use under the indirect method. So you can either, I'm not recommending for you to memorize it, but this is the standard format that is used for the indirect method. So what do? You take the profit before tax. You take the profit before tax, right? And then you do the adjustments, all these adjustments. Depreciation, foreign exchange loss, investment income, interest expense, increase or decrease in inventories, receivables, trade payables, cash generated from operations, interest paid, income tax paid, and then you get the net operating activities. Right? This is an example of a cash flow under the indirect method. A cash flow under the indirect method. Okay, so look at how they started. They are starting with the profit before tax. Then they are adjusting these items. Depreciation, they have added. Investment income, they have deducted. Now, why they have deducted? Investment income is already included in this. But we know investment income should be handled where? Under investing activity. Under the investing activity. Okay. Then interest expense is something that you have incurred in your P&L. But interest expense is what actually? You have to see how.
In provision.
Yeah. So if it is a provision, you will remove it and you need to consider the actual interest paid. You see? Actual interest paid. How much you have paid in terms of cash. Okay. Then increase in trade and other receivables, decrease in inventories, decrease in trade payables. These three, it is very important. Right? Now that is what we are going to look at. Right. So generally, when you are required to prepare a cash flow statement using the indirect method, if you are using the indirect method, you need to have a statement of comprehensive income, a statement of financial position, and the statement of changes in equity is also important. And you might also need some additional information. Right? Now, when you are preparing a cash flow, definitely, what are we talking about is, it is the cash that you have produced during the year. Because statement of cash flow is considering a financial year. So in order to do that, you need 2 years of information. 2 years of information. That is the current year and the previous year. Current year and the previous year. So 2 years information is relevant. So when you look at a financial statement, especially in the case of a statement of financial position, I told you it will have the 2 financial years, 2020 and 2019. Oh, it's like a comparison of 2 financial years. So the items that we looked at, what are the items? Receivables, stocks,
Inventory.
yeah, in an inventory or stocks. Then you also have payables. Payables. So you see, these 2 are coming under assets. This is coming under liabilities. Okay. The top 2 are coming under assets. This is coming under liabilities. So I'll just put some numbers. Right. Now, you have to carefully look at these numbers. Right? Let's say these are all millions. So receivables, last year it was 3 million. This year it is 2.5 million. Stocks, last year 1.5 million. This year 4 million. Payables, last year 2 million. This year 4 million. Right? Now, when you look at the numbers, what can you say about these numbers? What can you say about these numbers? Obviously,
2020 has more liabilities.
your asset position has come down here. Do you agree? Last year you had 3, this year it's 2.5. Here you had 1005, here 4, it has gone up. Last year you had 2, this year it has gone up to, right? So there is an increase. We always take the recent financial year to be the latest and you compare it with the other. So here there is a decrease of 500. Here there is an increase of 2,500. Here there is an increase of 2,000. Okay. In terms of value. In terms of value. Now I am going to ask you, what is the corresponding impact on cash? What is the corresponding impact on cash with regard to these 3 items? Let's take one by one. When you take receivables, the value has dropped. What is the corresponding impact on cash? What is the corresponding impact on cash?
Inflow.
Cash?
Inflow.
Cash inflow. Very good. Cash inflow. Why? Last year, there were debtors who were supposed to pay me 3 million. Right? They were supposed to receive, means I am supposed to receive cash. There were 3 million. Now it has come down to 2.5 million means during the year of 2020, what has happened? I have received cash. I have received cash. Look at stocks. Last year I had only 1.5 million. This year it has gone up to 4 million. What has happened to stocks? Stocks have gone up. Why the stocks have gone up? Because I would have purchased more stocks. Then when I go and purchase, what will happen? Cash will go out. Cash will go out. Cash will go out. Okay. Look at payables. Last year, I had only 2 million to be paid. Only 2 million to be paid. But when I look at this year, it has gone up to 4 million. It has gone up to 4 million. So what do you mean by that? I have increased my payables more and more, which means I have not paid even this. I haven't paid even this. So what do you mean by that? It is a favorable position to you. You are not paying cash. You are not paying cash. Now this can be summarized as follows. As follows.
Excuse me, sir. Can
Yeah.
you repeat again this liability one again?
I'll explain it. I'll explain. Right. So the first one, where the assets came down. So there is a reduction in assets. Yeah, there is a reduction in assets meaning in the form of receivable means I have received money because last year I had to receive 3 million. Now it has come down to 2.5. So which means I have received money. Second scenario, stocks. Last year I had only 1.5 million stock. Now it has gone up to 4 million, which means I have purchased more and more stocks. So money would have gone out. Money would have gone out. Now look at this. Liabilities. Last year I had to pay 2 million. So if I had paid this during this year, my liability would have come down. My liability would have come down. But what has happened? My liability has gone up. So which means I haven't even paid this. I haven't even paid this. So by increasing my liability, which is the payable means, that is beneficial to me because I am not going to lose my cash. I am just keeping the cash with me and I am just accumulating the liabilities. Okay. So that is what I am trying to explain here. Increase in assets and decrease in liabilities means that is a cash inflow. Sorry, cash outflow. Okay. Increase in assets. I told you, increase in assets is a cash outflow. Decrease in asset is a cash inflow. And these two are cash inflow. You have to remember, this is like a mantra. Increase in assets and decrease in liabilities. The opposite of it will be cash outflow. Decrease in assets, which is the receivable, And increase in liabilities, which is the payables, is a cash inflow. Right? Now, it is really looked at in terms of whether this is favorable or unfavorable. So, you know, cash inflow means it is favorable. When you say cash outflow, it is unfavorable. Unfavorable. So, actually speaking, this is the ultimate summary that you have to remember. Increase in asset is a cash outflow. Decrease in liability is also a cash outflow, because why your liability should come down? Liability can come down only when you pay cash. Only when you pay cash. So it's a cash outflow, which means it is unfavorable to you. Decrease in assets. Assets have come down. So receivables have come down means people have paid me. Similarly, increase in liabilities. Increase in liabilities means I have not paid cash. All the cash that I have received, I am keeping it with me. I am deferring those. It is again a cash inflow. So don't get misled by when your liabilities goes up means it doesn't really mean that you're getting cash, but you are deferring payments. You are deferring payments. And that is considered as a favorable cash position.
Sir,
Yeah.
my question is, the liability means the company, and I'm not taking as a bank.
Yeah.
I'm referring as the company has taken a loan. So in this situation, they didn't pay.
Yeah.
So they will think as a cash inflow is their favorable situation.
It's a favorable
situation for them.
Yeah.
But they have to pay with the interest in the future. So,
Yes.
so
That
that's
will happen.
what.
No,
that will be
that's what.
considered as.
Your question is valid, because what we are looking at is what has happened during the current year. In the future, you might have to pay interest. Yes. Now, say for example, I'll take another example here. This company has taken a loan, right? Last year, the loan amount that should be payable was 3 million. Now it is 5 million. What do you understand? I'm coming to the point of your question. This company has a loan which is supposed to be paid. Last year they are supposed to pay 3 million. This year it has gone up to 5 million. What do you mean by that?
Increasing liabilities.
Yes, this is a liability has increased. But when you take a loan, how can the loan go up without anything? So they have gone and taken another loan during the year. Didn't they? Last year they had only 3 million loan. Now it has gone up to 5 million. So what have they done? Without even paying this, they have gone and borrowed some more. So when you borrow, what would have happened? 2 million cash would have come into the business. Would have come into the business. So these two are slightly different. The interpretations are different. Here, the liability is going up and you are getting cash. Here, the liability is going up, but you are not paying cash, deferring cash payment. Deferring cash payment. But both these scenarios are favorable to the company. Favorable to the company. That is what you have to remember. One instance, you are deferring the liability. One instance, the liability is increasing, but the increase in liability is actually bringing in cash. Bringing in cash. Is that clear?
Yes, sir. Thank you.
Right. So I feel that it is better for you all to take down, and it will be easy. And this is what is important. You have to remember. So in the cash flow, actually, when it is a cash outflow, you have to show it as a negative figure. Right? You have to show it as a negative figure. But when it is a cash outflow, it's a positive figure. The positive figure. Any clarifications that you want? Okay, right. So this template actually gives you an idea about how the cash flows are presented. So you will see anything that is shown in negative or within brackets is an unfavorable cash flow, or in other words, it's a cash outflow. Anything shown in positive is basically a cash inflow, a cash inflow. So each and every item, say for example, purchase of property, plant and equipment. So when you purchase property, plant and equipment, what will happen? It will be an increase in assets. It is an increase in assets. So if it is an increase in assets, what is it? Cash
Outflow.
outflow. If it is a cash outflow, how do you show it? Positive or negative?
Negative.
That's why this is shown in brackets. You see? This is shown in brackets. Interest received. That is, you are receiving money. Cash inflow, outflow.
Cash inflow.
That is why it is shown on as a positive. As a positive. Dividends received. Cash inflow, outflow.
Cash inflow.
It is shown in as a positive figure. So you will see the first part of this gives you the cash flows from operating activities. You get the net cash flow from operating activities. Then you get the cash flows from investing activities. So from investing activities, you have a negative. Then you also go into the financing activities. Proceeds from issue of share capital. So you have issued shares and you have received money. Inflow or outflow? Receiving money is?
Inflow, sir.
Inflow. Any inflow, you will show it as positive, and any outflows, you will show it as negative. So then you get the net cash outflow from financing activities. Then you have to add the 3, that is 1,380, which is from operating activities, 480 negative from investing activities, 790 negative from financing activities. So when you add the 3, you get a net of 110. And to that 110, you go and add the cash and cash equivalent at the beginning of the year. That is, if your financial year ends at 31st December 2018, what you will do is, to the net cash flow position, you go and add the cash position where you had at 1/1/2018. So when you add it, you get the cash and cash equivalent at the end of the period. Okay. So theoretically, statement of cash flow is somewhat a technical subject. Okay, so it's not easy. Statement of cash flow is not easy. What you need to understand is, when you look at a transaction, you need to understand whether it results in a cash inflow or an outflow. So in order to identify that, I have given you the mantra, which is this table like thing that I gave you. Increase in assets, what it is. Decrease in liabilities, what it is. Decrease in assets, what it is. Increase in liabilities, what it is. Depending on whether it is cash inflow or out. Sorry, what is it? Yeah, proceed with your question. Okay, so you need to identify first whether it is a cash inflow or a cash outflow. Once you have identified that, just a matter of going and putting it under the relevant type of activity, operating activity or financing activity or investing activity. And you have to remember whether it is cash inflow or outflow. Depending on that, you will put it as a positive figure or a negative figure, right? So that is all about statement of cash flows. What we need to do is, we need to do 3 questions are there. One in September 2017. I don't know how many of you have the paper. Then there is one in March 2019. Please make a note. September 17, March 19, and then you have in January 2021, which is the latest paper, right? And I think the paper is also posted into your portal today. You might get it. Yeah, it's there in your portal. Oh, sorry, still it's not there. I think they will put it. So you can take the January 2021 also, and what we will do is, I need to take one more class to wind up. So what I have planned is, we will have a class on 21st of this month, 21st of July. I'm told it's a holiday. So we will have a class on 21st of July from 9 to 1. Morning 9 to 1. It will be like a 4 hours class. Yeah, I will have a break in between of 15 minutes because we need to wind up. So today is actually 11th. So basically you have about 10 days. So please make use of that time period to revise, right? So I think still you are lacking with regard to your revision work, because I saw that none of you answered with regard to the depreciation entries even. So it is very alarming that you are still not revised. Okay. So I would appreciate that if you can do some sort of a revision, a rapid revision. And when you come back on 21st July, we will wind up the session. But first I will look at the cash flow questions, and also some more other questions before we wind up. And I'll see whether I can give you all another question paper. If I can post it prior to 21st July, I will just post it on the group portal, so you can print it and keep it ready. If you want, you can do it also. Make it ready so that we can do that also in the class, which is also will be useful to you to understand how to tackle with these multiple choice questions. Okay, so what I'm going to do is like a summary of the past papers, multiple choice questions. I'm trying to put it in one paper and give it to you so that you can have it ready You can give it a try also, but we will do it in the class just to see how multiple choice questions can be answered. Okay. So, right, as I told you, in between these 10 days, if you want to get any clarification, you can always approach me. There is no issue. Right, so I hope 21st July is fine with you all. Are there any issues?
Yes, sir. Thank you.
Right, okay, then we'll meet up on 21st July.
Thank you, sir.
Thank
Okay.
you, sir.
Thank you, sir.
By the way, don't miss the class, 21st. Don't miss the class. That will be the last class, so it's very important for you all. Please attend.
Okay, sir.
And
Thank
later,
you, sir.
let your colleagues also know.
Okay, sir. Thank you.
Better for them to also to join.
Okay, sir.
Okay.